Welcome to Matco's Read Between the Lines, a monthly look at what's really moving markets beneath the headlines. I'll share the key developments that matter most, the context behind them, and I'll finish with a book that I've recently read and recommend. The books will often touch on investing, wealth planning, economics, historical perspectives, or simply topics that I find interesting. Be sure to stay until the end for this month's feature read. But first, let's dive into the first 30 days of the year. January is an important tone setter for markets. Despite persistent geopolitical headlines, including heightened tensions around Greenland and a U.S. military operation in Venezuela, markets delivered a constructive, though uneven start to the year. Equity markets finished January generally and broadly positive. Leadership continued to broaden, a theme that began in 2025. European and Japanese equities outperformed U.S. markets, supported by more attractive valuations and improving investor confidence. Notably, Europe's IPO market recorded its strongest start to a year in decades, an encouraging signal that risk appetite and capital formation have improved in the region. As outlined in our 2025 portfolio positioning and our 2026 outlook, we've been constructive on Europe given its attractive equity market valuations and pending fiscal stimulus. Now, a special shout out to Brazil for posting some of the highest returns year to date. Meanwhile, China and India continue to lag, reflecting weaker domestic confidence and ongoing capital outflows. This broadening of leadership beyond the U.S. reduces a reliance on a narrow group of technology stocks and supports more durable market returns, particularly when positioned accordingly. Now, in fixed income, bond yields were range-bound. Though most probably find bonds boring at the best of times, let's take a second to briefly chat interest rates. Strong economic data nudged rates higher at times, while geopolitical uncertainty supported demand for high-quality bonds, helping keep a lid on those rates. Now, despite significant debt issuance from AI-related companies to fund long-term investment, credit spreads did remain tight. Both central banks met late in the month, with the Bank of Canada holding its overnight rate at 2.25%, and the U.S. Federal Reserve leaving the federal funds rate unchanged at 3.75%. The biggest news for the interest rates is the announcement of Trump appointing Kevin Warsh as the next Fed chair. Given Kevin's background and experience, this has been well received. Now, how his relationship and alignment with Trump's desires for lower interest rates progresses will be interesting to watch unfold. Commodities were a standout. Gold reached an all-time high above $5,000 per ounce, while silver surpassed $100 for the first time ever. Milestones that highlight how investors are hedging geopolitical, fiscal, and long-term currency concerns away from the U.S. These moves proved short-lived. On the final trading day of the month, both metals reversed sharply, falling back below those psychological thresholds. Increasing our base and precious metal exposures in late 2023 and late 2024 and our opportunities in Canadian equity income strategies have in fact played out nicely. However, our risk management lens had us trimming metals exposures over the last couple of weeks, locking in some of those gains. Now, energy price action paled in comparison. In currency markets, the US dollar softened modestly while the Canadian dollar appreciated to roughly 0.74 per US dollar, its strongest level since late 2024, supported by firm commodity prices, relative economic stability, but mainly, and here's the key, the weakening US dollar. Matco manages 5 core investment strategies internally. This means our sleeves are rolled up and we're deeply involved in the success of our client portfolios. Our investment platform is off to a great start again this year, but the work continues. Now, my most recent read is 1929 by Andrew Ross Sorkin. In his own words, Sorkin set out to tell a fast-paced story of the final years of the Roaring '20s and the lead up to the 1929 stock market crash. His goal was to chronicle the period with the same narrative quality that Titanic, the movie, brought to the big screen. I think he did this very well. Through the book, Andrew illustrates how extreme speculation, widespread leverage, and weak guardrails turned a booming market into a historic collapse. This set the stage for the Great Depression. Now, Sorkin weaves in fascinating real-life characters, including the likes of J.P. Morgan Jr., Andrew Mellon, Charles E. Mitchell. By framing the story around the titans of finance and government of that era, the book highlights just how confidence and misjudgment can amplify both booms and busts. Now, I highly recommend, she is a bit of a doozy, 400 pages or so, but particularly if you're interested in history, investment markets, or both. My main takeaways from the book were healthy reminders that Leveraged investing is for a narrow, sophisticated, and select few, not the masses. In the 20s, leveraged investing became as commonplace as swiping your credit card for groceries. No bueno. Second, some things in the markets have changed drastically, while other aspects never will. Specifically, the interaction between politicians, investment banking executives, and the heavy hitter participants in the market, it existed then, and it still does today. Now, finally, the narratives around investment markets tend to move in dramatic waves. Less seasoned investors often allow their emotions and, by extension, their portfolios to mirror these swings. More sophisticated investors, by contrast, follow a straighter through line, filtering out the noise, both emotionally and in their portfolio positioning. Happy reading. I hope you enjoy.